Let's just talk about what is digital infrastructure. Let's start there, super simple. What are we describing here?
Yeah, it's a great question. I mean, I think to us, digital infrastructure really has three big pillars. There's mobile infrastructure. Traditionally, think of it as towers, telecom towers. There's the fixed line infrastructure. So it could be fiber that delivers connectivity to homes or enterprises. And of course, I think the topic we're about to discuss is cloud sort of storage and computing infrastructure, right? i.e. data centers, most pronouncedly. So those to us are the three big pillars, at least how we define digital infrastructure within KKR.
So let's talk about the investment opportunities and how much is going to be invested over the next several years. I want to reflect on a quote that came from the Google CEO, the Alphabet CEO, in the last couple of days, when he said the biggest risk here in a cycle with a theme like this is underinvesting and not over-investing. I sense from your perspective you're going to agree with that stance. Am I right?
Yes. Yes.
Why is that? Why is this such a big moment? And why is that the right way to look at the balance of risks?
Well, I think let's look at the computing piece, right, of it. I think two mega themes that we have are obviously under computing and last mile connectivity. And I think maybe we'll touch a little bit later on Metronet, which is a deal we announced yesterday in partnership with T-Mobile. But focusing on data center piece, I think if you look at United States and say, what was the infrastructure, what was the spend to help facilitate the build out of internet infrastructure or cloud infrastructure? So 16-year cycle from 1990 to 2006. 2 gigawatts. No longer do we think about data centers in terms of square feet. It's really about the amount of power that the data centers have. So that's an important factor there to consider, and we'll touch on that in a second. So internet infrastructure, 2 gigawatts. The next phase was Internet 2.0 and cloud, 8 gigawatts, about 15 years. Technology cycles have accelerated. So we're now talking about AI build-out, cloud 2.0, internet 3.0 as a 5-year cycle, and 25 to 30 gigawatts of power required to fuel this. So I think you had a more patient, sort of highly visible investment cycle that's now gotten compressed, and perhaps it's creating, I think, scaring some of the investors out there.
Well, some people would argue that this might be one big reason for the sell-off we've actually seen in big tech. There was one investor who said this in a recent story: the overarching concern is, where is the return on investment on all the AI infrastructure spending? It'll pay off in a few years, but it's not going to come anytime soon. That is what the fear is. Waldemar, how much are you seeing near-term returns on some of these infrastructure projects that a lot of people would agree may be crucial in, say, 10 years?
Yeah, I mean, I think it's a great question. I would draw an analogy to similar questions raised during the build-out of cloud in 2006 and 2007. So, when Amazon really emerged as the cloud provider in 2007, I think similar questions were raised about where is the ROI. A tremendous amount of investment is needed to help facilitate the build-out before you actually start seeing the applications of that. And if you fast forward 2007 to today, Amazon stock is up almost 3,000%, right? And it's been forgotten. So I think the concerns are valid. I do think that there's frothiness in parts of the ecosystem. Within digital infrastructure, at least how we're positioning ourselves, we don't see that. Most of the capacity on the data center side that's coming online is fully leased. Most of it is leased to the large hyperscale customers. So the type of risks that we're looking to take, we're not necessarily exposed to perhaps some of the volatility. But I think it's a fair question to ask. What is the ROI? I think AI will be larger than potentially cloud. If you think about it today, cloud business is about a $500 billion business annually, investing almost $200 billion to build that infrastructure. I think the view is that this feels different than late 90s, perhaps, bubble.
That said, you said that there's certain pockets that feel frothy and certain pockets that seem very worthy. What are those pockets? How do you distinguish the two?
Yeah, I mean, that's why I think we're trying to figure that out. So a big part of what we're doing at KKR is really trying to map the entire ecosystem from the silicon side, which is, I think, we're talking about chips, to the ultimate endpoint of applications layer, and trying to figure out how do we participate to the different strategies that we have within KKR. We're not a venture investor, so we're staying away from that. An interesting point I would make, in 1990s, a lot of analogies are being drawn to the 1990s tech bubble and bust. There were 38 or 39 stocks in 1999 that were up 100% in a year. Today, there's only one. So public markets, perhaps there isn't as much of a frothiness. Private markets, there's $15 billion of capital that has gone from venture capital funds into generative AI platforms. That's 10x the prior trend line. So I think perhaps there are parts of frothiness in the private markets versus the public markets. But I think we think of it as a long-term trend, sort of an industry 3.0, if you think about it in terms of long-term 300-year sort of a cycle. And we're pretty confident that we're still in early innings of that.
When you look at the investment, is it actual market demand, or some of this has to do with the fiscal push coming out of Washington?
It's fundamental market demand. I think we're seeing government part of this investment has not played a large role. Now, we think that in the long term, I think a comprehensive solution, which includes private capital, includes obviously a combination of the tech companies, intervention from some government policies to help facilitate the build out of some of this power infrastructure, which ultimately is a key component of this, will be required. From a KKR perspective, we think of it as we're pretty uniquely positioned to ultimately play a major role in that.
So you just announced a deal, and
Yes.
it was actually not on highfalutin cyber prowess in artificial intelligence. It was in medium-sized, smaller cities getting connectivity, basic connectivity to the internet, to the cell phone. How far behind are we in basic infrastructure at a time when we're trying to build out a massive network?
Yeah, so two mega themes. We touched on the cloud computing. The other big theme we have is fiber to the home. We've made over 10 investments globally, over $10 billion of capital just in the fiber to the home strategies over the last decade. We're pretty bullish. We think this is pretty important. So in the U.S., about 50 million homes still don't have access to full fiber. We think that that's unacceptable, and that ought to change. And so Metronet, which is the deal that we announced in partnership with T-Mobile, it's really meant to help facilitate the growth of that and really bridge the digital divide, not only in the sort of the, as you call it, the smaller cities, which, by the way, a smaller city in the United States called sub 50,000 population center has about the 1/5 of the speeds that you see in the major urban areas. And even in major urban areas, it's pretty inadequate. So I do think that we believe that there is a large decade-long investment cycle to help build out fiber infrastructure in the United States, and we're really happy to be part of it and happy to partner with a premier telecom operator like T-Mobile to do that.